Last weekend, Donald Trump fired the first shots in what could become a devastating global trade war, with the announcement of tariffs against Canada, Mexico, and China. While the Canada and Mexico tariffs were quickly suspended, it would be a mistake to assume that this is the last these countries have seen of his tariff hikes. The tariffs were implemented under the International Emergency Economic Powers Act, a U.S. federal law which allows the president to regulate international commerce after declaring a national emergency, which can be done in response to any unusual and extraordinary threat to the United States. Had these tariffs been implemented, they would have covered about 40% of American imports, really driving up prices for the American consumer. To delay the 25% tariffs, both Canada and Mexico agreed to deploy additional troops to their borders to combat the flow of fentanyl into the United States. This was the stated motive for Trump's tariffs. China retaliated with additional tariffs on liquefied natural gas, coal, farm machinery, and other US manufactured products, which will kick in this week. They also placed restrictions on the export of critical minerals, which are required for the production of high-tech goods, and announced an antitrust investigation into Google, which has been blocked in China since 2010, but still sells advertising to Chinese businesses. Trump, who has said that his favorite word is tariff, is very likely to come back for more, and is also likely to broaden his targets to include the EU and other Asian economies, in particular those he views as supply chain stop-offs and offshore production platforms for China. Just yesterday, Trump said that he would consider imposing tariffs on Japanese exports and pledged to unveil reciprocal tariffs on other nations next week. Tariffs are, of course, a tax paid at the port of entry on imported goods. The tax is paid by the person who imports the goods, and the money goes to the US government. It's not paid for by a foreign business or a foreign government. While Trump has said that he will create an external revenue service to collect the tariff income, the tax is charged in the United States and pushes up the price of goods, which is passed on to consumers. Once taxed, the foreign goods might be more expensive, or their prices might be in line with the price of domestically produced goods. If the imported goods are more expensive than domestically produced goods, this gives domestic manufacturers room to raise their prices and become more profitable. Tariffs can be used to protect domestic industry, to raise revenue for the government, or used to provide leverage in negotiations with foreign leaders. What makes Trump's use of tariffs different is that he's the first modern president to view them as a preferred form of leverage and to see them as a source of revenue, which they haven't really been used for much in the past. Most other presidents have viewed tariffs as a drag on the economy and as something that you want to negotiate down as part of a free trade agreement. A big difference, too, is that Trump is using tariffs as leverage for goals other than trade, which is quite unusual. Governments can raise revenue in a variety of ways through income taxes, corporate taxes, property taxes, sales taxes, even fees and fines. Tariffs are a method of raising revenue, but despite what some people claim, they could not reasonably be expected to replace income taxes. The US imported about $3.1 trillion worth of goods last year and raised about $2 trillion in income taxes. To try and raise $2 trillion in tariffs on $3.1 trillion worth of goods would involve massive tariffs, which couldn't work as the tariffs would slash the amount of imports and then fail to bring in the hoped-for revenue. It's worth remembering that all government taxes and fees are redistributive by nature, as usually one group pays them and another group benefits from government spending. Tariffs would be a tax on households and would benefit the specific businesses who find themselves dealing with lower foreign competition. As to whether those businesses would spend their extra profits by hiring or hiking wages really depends on the supply-demand dynamics for labor. businesses could just as easily reinvest their profits in mechanization if that made better business sense. On Monday morning, the news broke of a deal with Mexico to pause tariffs for 1 month. The Mexican president agreed to deploy the National Guard to the border to combat drug trafficking, while the US works to prevent smuggling weapons into their nation. Go to ground.news/PB to access more than 600 news sources Ground News analysed on this. A quick look shows 78% were rated highly factual, helping me separate reliable reporting from speculation. I can also see how the narrative has shifted, first breaking in Mexico before shaping global trade discussions. US-based Breitbart reports Mexico gave in to Trump's demands to avoid tariffs, while Mexico News Daily states their president would respond to Trump's threats with tariff and non-tariff measures of its own if necessary. So what's the truth, and how does this impact markets? To understand that, you need more than one version of the story. This is why I've relied on my partners at Ground News for years. Their app and website organizes the world's news in one place so you can compare coverage, track missing angles, and spot biases that might shape public perception and market reactions. For a limited time, you can get the same plan I use for nearly half off. Just go to ground.news/PB or scan the QR code on screen to get the Vantage plan for just $5 a month, a small investment in making informed financial decisions. Okay, so once tariffs are applied, how inflationary should we expect them to be? Well, tariffs can be expected to push up the prices of both imported and domestically manufactured goods. The effect on imported goods is fairly obvious. A 10% tariff will be charged at the port of entry and be added to the price of imported goods. That doesn't mean that the goods will increase in price by exactly 10%, as once goods arrive in the United States, they're typically transported across the country to their point of sale, sometimes being repackaged. The business selling them will spend money on advertising and pay to staff their retail outlets too. They'll also apply a markup so that they can earn a profit, and if the goods are sold online, charge for delivery. All of those costs go into the end price that the consumer pays, but only one of them has a tariff applied to it. So a 10% tariff will push up the price of goods, but it might only push up the retail price by around 5%. Domestically produced goods can also be expected to cost more once tariffs are applied, as many domestically produced goods require imported raw materials, which will, depending on where they're sourced, possibly be hit with tariffs. Even if they entirely avoid tariffs, domestic manufacturers still get to hike their prices when they see their foreign competitors raise prices. This price hike allows them to earn a higher profit margin. Now, while consumers think of prices going up like this as being inflation, that's not really how economists think about it. A 2008 paper from the Cleveland Fed points out that inflation is one of the most misused words in economics, where the term was originally used to describe currency and money, not prices. Strictly speaking, inflation refers only to a drop in the purchasing power of money that results when a central bank creates more money than the public wants to hold. This manifests itself as a rise in all prices and wages, not just some subset of prices. Milton Friedman famously pointed out that inflation always results from a monetary mismatch. It has nothing to do with supply chain issues or with bird flu pushing up the price of eggs. Tariffs being imposed would push up the prices of goods in the same way that a sales tax increase would, but it would be a one-off price hike that the Federal Reserve would likely ignore, except if it caused an economic slowdown that they decided requires intervention. Tariffs can cause an economy to slow down, as if the tariffs push up the price of essential goods, consumers are left with less money to spend on other goods and services, and this could be expected to slow the economy. There's also the issue of retaliation, where America's trade partners can be expected to push back by imposing tariffs of their own, which would then hit American exporters. This type of retaliation is more of an issue with countries like Mexico and Canada who have balanced trade. It's much harder for China to retaliate with their own tariffs as they import very few American goods to begin with. China instead retaliates by restricting the exports of things like critical minerals needed to make advanced chips, weapons, and munitions. Prices of these minerals jumped as soon as China announced these bans. China's main form of retaliation will be to put pressure on big American businesses who rely on manufacturing there, like Apple and Tesla. The US imports a huge amount of goods from China, and Trump's 10% tariff could hit more than $450 billion worth of imports. This is quite different to Trump's first term in office, as back then the tariffs were more targeted and applied gradually. This time around, more Americans will feel the impact. The Tax Foundation estimates that the new 10% tariff on Chinese goods will add $172 to the tax burden on every US household. This time there's no exemption for Apple, so iPhones and computers will be hit. During Trump's first term, Tim Cook managed to convince him to make an exception for Apple, as while Apple products were manufactured in China, their biggest competitor Samsung were manufacturing in Korea. So Samsung would have a cost advantage over Apple if iPhones were hit with a tariff. Starting a trade war with Mexico and Canada was a surprising decision, as the trading relationship between the US, Mexico, and Canada is the most important relationship for all three countries. Canada and Mexico are the United States' first and second largest export markets, and the US is the largest export market for both Canada and Mexico. Trade between these three countries supports over 17 million jobs, according to The Economist. The fact that the US exports so much to Mexico and Canada means that US businesses are much more vulnerable to retaliation. Supply chains between these three countries are so intertwined that an all-out trade war would be hugely destructive to all three economies, and no one would win. Mexico provides almost two-thirds of US fruit and vegetable imports, so food prices would be hit right away. North American car manufacturing is highly integrated between the three countries, with parts going back and forth across borders as many as 7 times during the production process. If each time they crossed the border they were hit with a 25% tariff, the US auto industry would really struggle to be profitable. About 70% of construction lumber and 70% of drywall come from Canada and Mexico, respectively. So the tariffs would drive up home construction prices in the United States, where there's already a construction shortage. In the short term, it would be extremely difficult to find new sources for these products. Canada is the largest supplier of energy to the United States, providing about 60% of its crude oil imports and almost all of its natural gas and electricity imports. Given that there are pretty much no tariffs between these three countries at present, a 25% tariff would cause a significant economic shock. The impact would be most severe for Mexico and Canada because a larger percentage of their trade is with the United States, but the economic hit to the United States would still be substantial, with some sectors like auto manufacturing being hit very hard. Trump's threats against Mexico and Canada are particularly surprising as they violate the trade deal that he himself struck during his first term, a deal which was already scheduled for renegotiation next year.
I look at some of the deals made, I say, who the hell made these deals are so bad?
US imports from Canada and Mexico are in fact higher than US imports from China, but these two countries also buy a lot from the United States, and their trade is mostly balanced. All three countries import more than they export, so it's hard to argue that Mexico and Canada are taking advantage of the United States. Trump claims that the tariffs are unrelated to trade and has tied them to border security and the opioid epidemic, which may actually be his concern, but it's hard to know, as in order to impose the tariffs, Trump had to declare a state of emergency, and that was the reason he gave to declare the state of emergency. The market reaction to the announcement before the pause was later announced was quite muted, with the S&P falling around 1.4% and the dollar rising. Oddly enough, crypto prices reacted more than the stock market did, with Bitcoin falling by almost 10% and Ethereum falling around 25%. This is obviously very concerning, as it appears that the meme coin industry is one of the real drivers of growth in 2025. A guy who has the unlikely sounding job title of Global Head of Digital Assets Research at Standard Chartered Bank gave some sort of an explanation to the FT about that. The fact that the stock market mostly shrugged off the tariff announcement implies that market participants don't believe that they were likely to be sustained, and possibly felt that this was a negotiation tactic like Trump's quickly cancelled tariffs against Colombia a week earlier. The problem with this lack of reaction is that it possibly gives Trump the green light for more extreme announcements in the future. While it might be reasonable to believe that the tariffs against Canada and Mexico were just being used as negotiating tools with no real intention of ever implementing them, the tariffs against China should probably be taken more seriously, as while a lot of negotiation went on between China and the United States in Trump's first term, not much came of those discussions other than an agreement to buy more soybeans, and eventually tariffs were applied. The balance of trade between the United States and China is extremely distorted, and there may be no real desire to negotiate. The tariffs are just being applied as a tax, which could be cranked up over time. If businesses believe the tariffs are just temporary, there are a few things that they can do, like drawing down their in-country inventories while waiting for a deal to be struck. Since the pandemic, businesses have been holding larger parts inventories to avoid the supply chain issues they had to deal with a few years ago. We also saw a surge in Chinese exports in the lead up to Trump taking office, likely driven by businesses building up inventories in preparation for tariffs. While this works if there are short disruptions, these inventories will only last so long, and eventually the tariffs just have to be paid. If Trump's goal is to onshore a lot of manufacturing, a more gradual rollout of tariffs would probably make sense, as that would give businesses time to adjust their supply chains. Trump closed a loophole known as the de minimis exemption, which allowed packages mailed into the United States containing less than $800 in goods to avoid duties, based on the idea that the government shouldn't spend a dollar to collect 50 cents in taxes. I believe that this rule was originally put in place so that individuals could bring back small value goods from overseas trips without having to pay customs duties or taxes. Chinese e-commerce firms like Shein and Temu, along with a lot of Amazon marketplace sellers, have gotten very good at exploiting this loophole, and this is part of the reason that they can sell goods so cheaply in the United States. Most countries do have a version of this rule, but with different thresholds. It's $800 in the United States, $155 in Europe, $170 in Britain, and only $20 in Canada. I've occasionally bought something online in the UK and had to go down to the post office to pay the tax to get my parcel released, which can be quite inconvenient. The US Postal Service initially stopped accepting packages from China on Monday when the announcement occurred, but resumed service the next day. According to The Economist, America's customs agency lacks the manpower to examine even a fraction of the incoming parcels from China, and the cost of building that infrastructure might cost more than the taxes raised. It's not crazy to narrow this loophole, but it would have made sense to put the systems in place to collect the taxes before implementing the rule. Now, about 5 minutes before I recorded this video, news broke that Trump is pausing his suspension of the de minimis exemption until adequate systems can be put in place to collect the revenue. You'd normally expect something like this to be worked out before a rule is passed, but things are a bit more chaotic now. So is Trump right about US trade being out of balance? Well, he kind of is. In 2023, China ran the largest annual trade surplus for any country in world history, where they sold $823 billion more goods than they bought. Then last year, they surpassed that when their trade surplus grew by a whopping 20% to $992 billion, which is just under $1 trillion. China imports next to nothing from its trade partners other than commodities and computer chips. Chinese imports of manufactured goods as a share of GDP have in fact been falling since 2005. According to Brad Setzer, if you strip out components that are bought in for re-export, import of manufactured goods for domestic use come to less than 4% of Chinese GDP. The economist Michael Pettis argues that surplus countries like China suppress domestic consumption, subsidize their manufacturing industries, and then pass on the costs of these subsidies to deficit countries, like the United States. He argues that a free trade country with open capital markets when trading with a planned economy is not really engaging in free trade. They're instead accepting the inverse of their trade partners' trade and industrial policies. Trump's former trade representative, Robert Lighthizer, recently wrote in the New York Times that nations are supposed to export in order to import. This exchange is intended to raise the standard of living for citizens of both the exporting and importing countries, and countries should export what they make best and maintain balanced trade by importing goods that are made relatively cheaper by their trading partners. That is the theory, he says, but this has mostly not happened in practice. Instead, many countries have adopted lopsided industrial policies that allow them to export much more than they import. Their objective is not to raise the standard of living of their citizens, but to accumulate power and wealth by buying assets abroad. Lighthizer argues that tariffs are necessary to bring global trade back into balance. He goes on to argue that countries with democratic governments and mostly free economies should come together and create a new trade regime where they work together imposing tariffs on countries that suppress wages and consumption in order to export more than they import, forcing the inverse of their industrial policies on their trade partners. This argument of trade cooperation between countries who run persistent trade deficits is very similar to Michael Pettis' arguments. This is not what seems to be happening, however, as both Canada and Mexico are deficit economies like the United States and should be on the same team. It would appear that Trump takes a more transactional approach to diplomacy than we've seen with other presidents in the past, where he doesn't worry about building long-term relationships and cooperation, instead focusing on striking deals where he wins. The problem with that approach is that once countries are no longer expecting long-term relationships, they have to make backup plans that might not be advantageous to the United States. Canada, for example, exports 97% of its oil to the United States, and while there have been discussions for decades about shipping oil to other countries, Canada's good relationship with the United States and environmental protesters have meant that pipelines to the coast were never built. Canada's Natural Resources Minister said this week that the country should weigh building a new west-east oil pipeline after Trump's threatened tariffs exposed a vulnerability in energy infrastructure. It does make good sense for Canada to have a backup plan like this, but this may not be good for the United States in the long run. With so many countries running persistent trade surpluses following the post-World War II Japanese and German model, there's no shortage of supply in the world, and without a handful of countries like the United States, there would be a shortage of demand. While there has been a lot of talk about how countries should stop relying on trade with the United States and trade with Europe or China instead, we have to remember that these are both trade surplus economies with no plans to run a trade deficit. To quote Michael Pettis once more, The idea that trade with the world's largest deficit economy could be replaced by trade with the world's largest surplus economy implies a world in which sellers don't need buyers. For most countries, trade with China could in no way replace trade with the United States. If the next 4 years are likely to be anything like the last few weeks, where tariffs are threatened, ordered, and then quickly cancelled, it creates an awful lot of uncertainty for businesses, as if a company can't decide where to build factories or who to sell to or buy from, they start to take a wait-and-see approach to business planning. This may be a wise business decision, but it would be very bad for the overall economy if every business were to halt expansion plans because of trade uncertainty. According to the Financial Times, tariffs have been discussed on over 200 corporate earnings calls this year in a sign of how Trump's policies are rippling through corporate America. Analysts are grilling corporate executives as to what their contingency plans are for possible trade disruptions. One of the benefits of long-term trade deals like the USMCA, which Trump struck 5 years ago to replace NAFTA between the United States, Mexico, and Canada, is that they lock trade relationships in place, sidelining government and allowing businesses to get on with producing and selling goods in a stable business environment. As of this week, Canada and Mexico have 1 month to arrange a deal with the United States. Even if they work something out, they'll possibly be left wondering if the United States will stick to their word or if it'll be broken on a whim like the current trade deal was. It would probably be wise for them to come up with contingency plans in case another national emergency is declared to break whatever deal they strike.
Who the hell made these deals are so bad?
Brad Setzer of the Council for Foreign Relations pointed out in a recent podcast that there are many reasons for the US trade deficit, one of which are US tax policies that penalize US companies who export from the United States, instead incentivizing them to hold their intellectual property offshore and manufacture offshore too. Better tax policies would possibly do a lot to bring manufacturing back to the United States. In the same podcast, Setzer raised the question of whether Trump's overall goal is to recouple or decouple from China. Does Trump want to stop trading with them altogether or strike a deal with balanced trade? Right now, we just don't know. While the US will be able to reduce its imports from China, which will mean having less access to cheap goods, China won't be able to find a substitute for the United States in trade, simply because no other economy or group of economies would be able to absorb the $1 trillion of excess production China is exporting every year. If the United States pushes hard, China would be forced to balance its economy and raise workers' wages so that they can consume more of the goods being produced in the country. This would be a very difficult adjustment for both the United States and China. If the US is to balance global trade by moving in the direction of a system where countries export goods in order to fund their imports rather than running persistent trade surpluses, it would likely require cooperation with other deficit economies like the UK, India, France, Turkey, Canada, and Mexico, who would need to work together to strike a long-term mutually beneficial trade deal. If you found today's video interesting, you should watch my video on the Great Depression next, where I look at the differences between the Smoot-Hawley tariffs and the situation today, which is very different. Don't forget to check out our sponsor, Ground News, using the link in the description. Have a great day and see you in the next video. Bye.